Today, the Reserve Governor and the board met and they've dropped interest rates once again. So following the February rate cut, they've followed it up with a May rate cut. Now, the reason behind that is simply the spare capacity that we're still seeing in the economy. So they've made a judgment call even before we see the May budget being released that the economy could do with a little bit more stimulus. So this monetary policy decision will hopefully support the fiscal policy work that the government's doing to try and build up sentiment confidence in the business industry and also continue to keep driving consumer sentiment and around spending and consumer confidence. So even though we saw a surprise number in terms of an uplift in employment in the March data, we saw 37,700 jobs created in that time. The Reserve Board said, you know what, that's in the past, we need to look for the future. And we still see that spare capacity as we see the slowdown out of the capex in the mining sector. Now, we have seen iron ore prices and raw minerals start to increase in price, and I think one of the other triggers may have been the rising Australian dollar. Last week, we saw the dollar basically rise around 5% off its lows, and that may have been another concerning reason why the RBA has said that we need to move on rates. They've done that, so now it's a time to see how this sits. Now, I would suspect that that's going to be it for this cycle. I'm one of these people who is confident that the construction activity that's occurring, the approvals that are coming through in the housing sector and the flow onto the broader economy are going to see these rates at these low levels, not for a long period of time. That being said, when I say those, the historically low levels, not for a long time, but I don't see rates getting up to that 7 and 8% period for many, many years until we really see the economy firing. The other reason I think the RBA decided to pull the trigger for this month was the inflation data. The inflation data was nice and clear that there was capacity. So the genie again is well and truly in the bottle. So we're in a position now where we can see the opportunity for the Reserve Board to pull the trigger, and that's exactly what they've done. So we'll see a couple of weeks before our lenders pass on those cuts and those savings to the households. It's still going to be a challenge for all of those deposit holders and retirees who are looking for alternative means in which to park their money to get decent returns other than in the bank and term deposits. That is going to put pressure on housing prices. So I do hope that APRA and the Reserve Government will actually work together in terms of thinking about ways in which we can slow down this aggressive activity that's happening in the property market. And I'm a property investment advisor. It's what I do. I am concerned about certain markets. Sydney is definitely the hottest property market on the planet at the moment. So for those people who are looking to get into the market and this being a stimulus, I would say tread with caution. It is a dangerous marketplace to get into. We see these cycles. Be fearful when others are greedy and be greedy when others are fearful. So we are seeing this FOMO, fear of missing out, occurring in the property space, and this is going to be a catalyst for that. So be sensible about what you're buying, stay within your budget, make sure when you are looking to purchase property that you factor in interest rates and being able to service loans at around 6%, because remember, your loan is for the long term. It's a 30-year or 25-year loan term, so rates will eventually get higher. So it's important for you not to overpay because you fear of missing out. It's an interesting time in our economy. Let's hope that this final bit of stimulus in the monetary sense, with a bit of smart fiscal activity from both our federal and also our state governments, will see us through to even further prosperity. Incredible to think that we've had such an amazing run into almost 25 years of this positive economic growth. It's an unbelievable story, thanked by our Asian partners in terms of looking to work with us in our export-driven activity. It's an incredible story. We're very, very fortunate. And now it's time to see what this rate cut will do. And let's look to next month and the following months. But for now, this is it. I think it's now time to start thinking about fixing a portion of your loans and then basically enjoying the rates while you can. And if you've got spare capacity, potentially start paying down some more of your mortgage, or look for opportunities where you can get a better return on your money other than in term deposits. Thanks very much for watching.